Welcome to Engaging Aging with Erin and Lauren.
Join us as we share laughter, tears, and demystify the realities and silver linings that occur later in life.
Welcome to today's episode to all of our listeners. My name's Erin DiCarlo here with Dovetail Companies, and today we are talking about the almighty dollar. How to really tap it into the equity in your longtime home to fund your future. And for many older adults, their wealth and their investment may be their home as their largest investment. So we're here very excited to bring to you today Zach Smolkin, who is an estate planning attorney, as well as Matt Lazowski with Fairway Mortgage. He is our what we call HECM, Home Equity Conversion Mortgage Specialist. And we really want to demystify reverse mortgages. Dun, dun, dun. So I'm going to start with you, Matt, if you can really just explain what is a reverse mortgage or a home equity conversion mortgage.
Sure. Thanks for having me here, Erin, today. It's great to be here with you and Zach. So a reverse mortgage is the global term for two types of mortgages. The home equity conversion mortgage is the mortgage that's specifically insured by FHA and regulated by FHA. And then there's proprietary types of mortgages that we call reverse mortgages. So we'll talk about the HECM. They're essentially the same. There's some very minute details and differences, but as it relates to our listeners today, I think the HECM is the topic. And so what it is, essentially, it allows people who are 62 years age or older, so that's an important point, is we must be 62 years age or older to qualify. Okay. And then what we do is we look at the equity in one's home, and based on one's age and the current interest rates, which are determined a little bit differently for reverse mortgages than, say, regular mortgages, we can determine how much they can borrow. And in today's world, there are about $12 to $13 trillion of equity tied up in homes, which is the number one source of equity in all of America, more than IRAs and 401ks.
Great. Thank you for that explanation. Now, for all of us in the aging space and in the elder care world, reverse mortgages have had a little bit of a bad rap through decades. Zach, question for you. You are here as an estate planning attorney, really talking about the benefits of reverse mortgages. Can you talk a little bit about, you told a story about talking with a professional last night and what came up. Can you share that story with us?
Absolutely. So yesterday I was talking to a friend and I said I was doing this podcast on reverse mortgages, and she's in banking, and she kind of gave me a look like, why would you do that? And I think she, like many other people, are in the world of 25 years ago, where the only reason to do a reverse mortgage or a HECM it would be if you're in distress and you can't pay your mortgage. However, there are so many other things that you can do if you free up money from your home, as far as moving assets to your children or down the line to your grandchildren through estate planning. So having that extra money there available is a great opportunity, and this is a great way to get that money.
It's so interesting you bring up, obviously in your title is estate planner. I think when we talk about planning for our future, it's an oxymoron to say I'm in crisis and need to plan, right? So in your professional opinion, tell us about these HECM products in pre-planning in those earlier stages, maybe at 62 and not 82.
Absolutely. Many clients want to make gifts or do other planning, but they just don't have the ability to. You can't give away your home. That's where you're living. That's where you're going to be, hopefully, until you die. So the ability to access some of the equity in there without having the obligation to continually make payments allows you to free up that money to be able to give gifts, to be able to do other estate planning techniques that we can get into a little bit later.
Great.
But having that lump sum of money there available to you really frees up your ability to do significant planning.
Great. So Matt, on that point, why is it beneficial for someone to consider this product sooner rather than later? What monetary value does that bring to the table to be considering these options at 62 versus 82, for example?
Good question. So I think there's two categories. There are the categories of people who say at 62 years of age, they're going to wind down. Maybe they got package to leave their job, and now their income isn't what it used to be. And so they have a continual mortgage payment and their cash flow isn't there. So in this case, a reverse mortgage is going to dramatically benefit them from reducing that outlay, and their cash flow is going to be higher, right? So basically get rid of their mortgage payment, and God willing, they live to 92. They're living in their house without a mortgage payment. It's incredible. The other way to look at it is, let's say somebody has great cash flow and they don't need to get rid of their mortgage payment. One thing they can do is they can get a reverse mortgage and have a line of credit based on the equity that's in their house that they qualify for. And that line of credit grows per FHA regulations at the same rate as the reverse mortgage would. And so that can grow every year, compounding. And of course, you can check with your accountant, but because it's a home equity, there's no tax implications typically to that. So that growth can compound without any tax implications.
So this is a very important point that I'd like to spend a little more time talking about in this risky investment market. And I'm not a financial planner, but I see the news and read the headlines where return on investment has been challenging. Can you speak more about the security and safety of using this product as almost an investment tool for that return on investment as it grows? Am I saying that correctly?
Sure. I mean, we in the mortgage space would never say use a HECM line of credit as an investment tool. What we would say is you can leverage your home equity and take advantage of the FHA regulation for that compounding growth. But to your point about safety and risk, things like that, first off, one who gets a reverse mortgage is never personally on the hook for that mortgage. It's backed by the home. It's called a non-recourse loan. You don't have to pay it back if you don't want to, as long as you live in the house. And so really the risk is almost minimal to none to the individual borrower. And secondly, on average, over the past 30 years, home values have appreciated on average 4%, right? So your asset is growing every year, the value of the home, as well as that line of credit based on the interest rate. That changes monthly based on the CMT.
And I think it's important to address how different this is from a traditional just home equity line of credit, which is income based, which you have to make payments on. This is a different product. I think sometimes consumers can confuse the two. This is a totally different product. From an estate planning perspective, Zach, what would you advise clients to use this money for as needed through their aging journey?
Absolutely. And Matt, as you pointed out, they can take that money out and it can grow when it's sitting in their accounts. At the most basic level, right now you can get 5% on a high interest savings account. No risk involved at all. That's 20, you can get a significant amount of additional cash flow that you can use to make gifts, to live your life, whatever else you might need that money for as you're aging. However, if you want to make estate planning decisions based on having additional income, we can leverage that in a number of ways. You can buy life insurance with it. Take a portion of it, buy a life insurance policy. Life insurance policies have some of the best internal rates of return of any investment you can make because it's guaranteed. And especially given the fact that you can take out a large sum of money, you can do a one-pay policy with that, and it just goes and it grows. And when you die, you could turn $100,000 into $1 million, $200,000 into even more than that, depending on your insurability and other factors.
Why do you think professionals aren't utilizing this to the best of their ability? This is a big question I have because obviously you and I, after meeting and learning from Matt, we're very excited about this product for planning purposes, but why do you think other professionals are not advising this for their clients?
I think that they're stuck in the 1990, late 90s state of mind where the only reason to get a reverse mortgage and the only people who get reverse mortgages are people who are in distress. And Matt, you can probably speak to that very well from what you've heard from other mortgage professionals and clients. But I think that they're just stuck in that mindset that says, I'm getting a reverse mortgage because I've turned 65, I'm not working any longer, and I can't afford my mortgage payment. So that's the only option I have. Whereas I think that this is potentially an amazing estate planning tool or planning tool moving forward.
It's great. I agree with you. And like anything in life, a goal without a plan is just a wish. So if there's a goal to gift or to stay home and bring in care services in the future, how are you funding that plan?
Exactly.
And this can be a great tool for that. Let's talk briefly about the crisis later in life person that this could be a great resource for as well. I want to tap on that.
Yeah, absolutely. And I've had, just in the past month or two, numerous people who are basically penniless. And their home is in disrepair. They don't have any family around. Or I have another gentleman, he still has a mortgage payment. He was just diagnosed in his late 60s for Parkinson's. And this is going to change his life. So we're going to be able to pay off his existing mortgage, get rid of that monthly mortgage payment. You do have to pay your property taxes and homeowner's insurance, but we're significantly reducing his monthly cash outflow. And he's going to have peace of mind that he can now live in his house from here on. And again, God willing, he lives a long time, but the peace of mind is incredible. And from somebody who offers his product and can teach about and teaches about it, it's I'm passionate, right?
Yeah.
It's really, to me, it's a mortgage, but is truly a financial tool that can be used in a variety of ways. And certainly the loan of last resort is what people have thought about. And it does work for that. And when in those times that it happens, it's an incredible opportunity to better someone's life.
That's why we're so excited to really demystify this today. I think Lauren and I always say to our clients, the best decision is an informed one. So really getting the true information and not just like kind of the hearsay of those reverse mortgages of the past. So we hope some professionals are also listening to this today, and we'll dive in to learn more about this. I have a question for you, and this really interests Lauren and I and our team. We are senior real estate specialists. Our real estate services specifically focus on supporting older adults. Many of our clients, their longtime home no longer serves them for a variety of reasons. Sometimes the children are gone and they don't need the 4 or 5 bedroom colonial home anymore, or maybe the landscaping and the upkeep is too much. There is a product where you can use this HECM, home equity conversion mortgage, to purchase that next home. And before I ask you a question about that, I just want to address this. Many older adults are staying in their homes because they don't have a mortgage. And it doesn't make sense to them, typically financially, to sell their home and then purchase for a high price point and lose all of that investment into another property. Please take a few minutes to explain what this product is and how it can help that person, that mature seller, really right-size into a new home that fits their needs and their lifestyle.
Great question. And I'll give you 2 examples. I'm working with a gentleman now who just sold a house up in Maine. He moved down to Rhode Island. He was diagnosed with a neurological disorder that he knows will get progressively worse. So he moved closer to his son. He's currently staying with his son, and we are going through the application process to get him a pre-approval letter to go out and buy a home with a HECM. And so he's, based on his age and the current rates, he can get a $300,000 home. He has to put down around $200,000, but he has that money because he just sold a house, and now he has no mortgage. Right, so that's a great example. Another one is in Metro West, homes are well worth over $1 million. As you said, they're paid for, but there is upkeep. The taxes are very high. What they can do is sell that house, get that $1 million. They can go out and get a comparable house for another $1 million, and based on their age, maybe put down $500 or $600, pocket the rest, and live without a mortgage.
So to explain that one step further, they sell a home for $1 million. They purchase a home for $1 million, but they're only putting, let's say, $500,000 or $600,000 down. That other amount, the $400,000 remaining, is the HECM product. So there's no mortgage payment. That difference is paid. And does that also grow for them with this as the equity in that property grows? Does that $400,000 also grow for them they can tap into in the future for need?
So that $400,000 is actually the mortgage,
Okay.
right? So they're borrowing that, And that does grow. So the reverse mortgage essentially says you're having negative amortization. So you are borrowing $400, and every year that $400 will grow. But keep in mind, they already have 60% of equity.
Yes.
Right. So the big fear, and I think Zach, your friend who you were speaking to last night, the biggest fear is the bank will own my house. Doesn't the bank own my house? No. The bank owns your house just like the bank owns your house when you have a regular mortgage. I think I have a mortgage, and my mortgage company has a lien on my home. I am on title, and they are on title. That's exactly how it is in a reverse mortgage. You do not lose ownership of that at all. Now, as the property grows in value, so in the case $1 million house you sell, you put down $500,000, $600,000, $700,000, you have $300,000-$400,000 in the bank. In the bank. As that home appreciates every year, you theoretically could refinance that reverse mortgage you used to purchase and tap into that equity based on home appreciation.
Got it. Okay, great.
Yeah.
And Matt, I'm sorry, I actually have a question for you, kind of related to this. I have clients all the time whose children move in with them, and they live there together, and they never know what to do, how to get it all equalized, because that child lives with their family. They live there for 20 years, and they don't want to kick their kid out when they die. But at the same time, they say, well, what do I do? How do I equalize everything? My house is my biggest asset. So it seems to me that they could take a reverse mortgage and give that money to the kids. And then I guess maybe you can explain how it would work, though, when they die. Does the bank then automatically force them to sell the house? Or is there an opportunity to refinance? Or how can they make that work? Because it seems great to me that you could push that down the road a significant amount. Having the child take over that house, but you can also equalize your other kids in many ways using that reverse mortgage.
That's a great question, Zach.
Great question. So you bring up a great point, right? So I always like to say, and I think all people, I'm going to leave the home to my children when I pass away. And I say to them, well, wouldn't you rather give them cash with a warm hand instead of a cold one, right? And people are like, oh, that's a great point. So to your point, absolutely what they can do is they can do a HECM for refinance to get the cash out, right? Tax-free because it's home equity. They can balance out that inheritance, so to speak. And keep in mind, even if they're 80, they're not going to be able to take out 70%. The home really will not be underwater, maybe 50 or 60% in this interest rate environment. If and when they pass away and their children under 62 years of age or older, the regulation states that you really have to pay off that reverse mortgage. So there's a couple ways. If the children want to buy it, then they would have to get a mortgage to pay that off. And the way that works is they can buy it for 95% of the appraised value. So you get an appraisal, and if they want to sell it, then they can sell it. They pay off the reverse mortgage, whatever's owed, and then the family keeps the rest. Yeah.
That brings up, you briefly mentioned tax-free. When we're talking about estate planning and selling a long-time home, capital gains taxes, taxes always come up in conversation. Can you talk a little bit about the benefit of this tax-free component of this product?
Sure. And I'm going to preface this by saying I am not an accountant. Yes. I am not a tax professional. My understanding is, and if I'm incorrect, I would love any CPAs or financial professionals to reach out to me. But my understanding is when it relates to home equity, there are no tax implications because it's not income. It's the equity in your house. So when you're doing a reverse mortgage, say refinance to cash out or have this line of credit, what you're really doing, it'll be funny, you're converting your front door, your window, your rug, your sink to cash, right? And that's all you're doing is the value to cash. And my understanding is there's no tax implication to that. And because of this FHA very cool regulation, that line of credit has a growth component compounding every year. That compounding growth is also not taxable.
So for me, I think about many of our clients are moving into continuing care retirement communities, and there's usually a decent runway of planning time, years leading into that decision and that transition. Oftentimes there are serious tax implications for drawing upon investments to come up with the upfront purchase to buy into these communities, where I'm just thinking this could be a great tool to have on hand, let it sit, let it make interest and compound, and then you have the cash on hand to purchase into these communities, and then that gets paid off. That mortgage line ultimately in the future gets paid off once you sell the property. Is it within a year after leaving? How long does someone have to pay back this loan after they've either passed or moved out of the home?
Yeah, it's like on paper, black and white, it says 6 months.
Okay.
There are people who say, people who are healthy and living and have a second home in Florida, as long as you're living in your home, say here in Massachusetts, for at least 6 months out of the year, it's considered your primary residence. If somebody has to go into an assisted living or a nursing home, and I just had this come up where a daughter is the conservator POA for their mom. Their mom had some significant memory degradation, and there were nurses coming in, but it got to the point where that she had to go into a assisted living memory care facility. Reverse mortgage, unfortunately, is off the table for her because now the mom's not going to live there anymore.
But
Yeah.
5 years ago, it could have been a great tool.
It could have been a great tool. And, that's what happens. It's people think, a little too late. And it's, Zach, I'm grateful as a mortgage professional that somebody in your position at least is looking at this as just another tool or piece of information as part of the planning process. And I met with multiple estate planning attorneys and, life and disability insurance and CPAs and financial advisors who are starting to realize, hey, this is just another piece of information for me to give to my client. I'm more knowledgeable, they're more knowledgeable, and they can make an informed decision. And that's what the goal here is.
Exactly. I mean, it's potentially an amazing tool in the whole quiver of arrows that we have as advisors to say, well, this is another way to get a little bit more money that you can do what you need to do with. It really could be highly effective for many clients.
Great. Well, I just want to thank you both for joining us today. There's obviously a lot more conversation we can get into on a deeper level with this. If anybody's looking for more information, we'll have notes in the show on how to contact us. But please think of these home equity conversion mortgages. Talk to your financial advisors, your estate planners, your CPAs. And together, I think we can really change the way we view this product and be able to get creative in our planning and funding tools for our future. So thank you for joining us today.
Thanks, Erin.
Thank you so much.
Thank you for joining us today. To continue the conversation, follow us on social media at Dovetail Companies or visit us online at dovetailcompanies.com.
And remember, change can be difficult. Aging doesn't have to be.